Welcome. Thanks for joining us. I'm Shannon Siri, an economist with Wells Fargo's Corporate and Investment Bank, and I'm joined today by my colleague, senior economist Tim Quinlan, to discuss the outlook for corporate debt in the context of higher interest rates. So Tim, the Fed is set to increase rates quite quickly here, and financial markets are very focused on understanding how the economy is going to perform in a higher rate environment. With debt in the non-financial corporate sector currently at an all-time high of close to $12 trillion, is there a reason or cause for concern that we should worry that corporations are soon not going to be able to meet those debt obligations?
Well, you're absolutely right that the debt in the non-financial corporate sector is at an all-time high, and that's true both in dollar terms and also as a share of GDP. And an important thing to consider in the context of this is that the interest coverage ratio is also at an all-time high, and that's kind of a way of gauging how well a corporation is able to continue to finance its debt. And there's a couple of reasons why the interest coverage ratio is high. One is earnings have been pretty strong, and the other is for years now they've built up a lot of debt at very low interest rates. But as you say, the Fed is set to start raising rates by our forecast about 275 basis points of rate tightening between now and the middle part of next year. And obviously that has people worried about the impact here. So a couple thoughts. One, about 70% of that debt is tied into longer-term financing arrangements where the interest rate is fixed. But for that remaining 30%, there is certainly some risk around that. And so in order to frame our thinking around this, we ran a few different hypothetical scenarios to try to stress test things and see how things played out. So Shannon, how did those go?
That's right. So as you said, we ran two different scenarios where we're projecting out the interest coverage ratio. And in both of those scenarios, we grow interest expense based on that Fed funds forecast that you just presented. And we keep EBIT constant, really, for simplicity purposes. But in the first scenario, we grow the maturing debt. We refinance that at the higher interest rate at both that 30% variable and 70% fixed rate mix. And then in the second scenario, we not only roll over the maturing debt, but we also grow new issuance at its pre-pandemic trend. So we really think of these as the lower and upper bound in terms of that interest expense, given that companies, will perhaps adjust their new issuance in a higher rate environment. But in both scenarios, the interest coverage ratio does decline, as you'd expect, but it only gets back to about the midpoint range of over the past cycle. So not at a point where it's overly worrisome that, again, corporations won't be able to meet these debt obligations in the near term, or at least through 2023, which is our current forecast horizon.
Right. So basically, there are a lot of things to be worried about in financial markets today, but the record high debt in the non-financial corporate sector is not really at the top of our list. Rising interest rates will present a little bit of a headwind, but firms should have no problem maintaining and financing even those high levels of corporate debt. Thanks for joining us for this Economic Insights video, and we look forward to seeing you next time.